One number changed everything: 151.8 billion yen. A blue-chip icon that sold televisions to families and turbines to utilities suddenly looked fragile, because the bedrock investors rely on earnings turned out to be sand. The case is a window into how target obsession, soft-spoken but rigid hierarchy, and exploited accounting rules can corrode a company from the inside without a single spectacular heist. It's not a story about one rogue trader or a back-alley shell company. It's about systems, pressure, and how respectable tools become weapons when incentives drift. Toshiba sat at the heart of Japan's industrial establishment. The conglomerate touched consumer tech, infrastructure, semiconductors, even nuclear power. Its managers were expected to deliver steady growth across wildly different businesses, quarter after quarter. That expectation matters, because it set the tone for how performance was discussed, reviewed, and, eventually, manufactured. On paper, the rules were clear. Japan's Financial Instruments and Exchange Act governs disclosure. The Financial Services Agency and its investigative arm, the Securities and Exchange Surveillance Commission, enforce those rules. Internally, you had the usual three lines of defense: operations, risk, and finance controls, and internal audit, overseen by an external auditor. In practice, each line turned out to be thinner than it looked when top-down targets hardened into non-negotiable orders. The cast is not a rogues gallery so much as a pyramid. At the apex, senior executives set aggressive profit targets and timelines. Beneath them, division heads in areas like infrastructure projects and personal systems were tasked with figuring it out. Controllers and accountants translated field reality into numbers, often via the percentage of completion method used for long-term projects. Internal audit sat inside the house, but culturally it did not have the oxygen to challenge the house. Outside, the statutory auditor, an affiliate of a Big Four firm, was supposed to be the skeptic of last resort. Around them stood regulators, investors, employees with bonuses tied to divisional KPIs, and customers whose contracts governed when revenue could truly be earned. The timeline traces a slow bend, not a sudden break. Over multiple years leading up to 2015, profits were boosted across segments through a cluster of techniques that, in isolation, could look like judgment calls. Under pressure, judgments drifted in one direction. In mid-2015, an independent investigation panel concluded that operating profit had been overstated by roughly 151.8 billion yen across the period from 2008 to 2014. Days later, the chief executive resigned, followed by other senior figures tied to earlier periods. By December 2015, Japan's enforcement machinery had recommended and then imposed record administrative penalties for accounting violations. In early 2016, the ripples were still spreading. U.S. authorities were examining ramifications for American investors, and the company was cutting deep to stabilize a balance sheet now stripped of the veneer the inflated earnings had provided. The crucial point for our purposes is that the core scheme, the key resignations, the record penalties, and the initial cross-border regulatory lens all landed by 2016. Mechanically, the heart of the issue was how otherwise legitimate accounting methods were bent under command and control pressure. The percentage of completion method lets companies recognize revenue on long-term projects based on estimated progress. That's acceptable when estimates are neutral and grounded. It turns toxic when estimates become levers. If you underestimate total project costs, the math generates higher current margins. If you defer the recognition of expected losses into later periods, today looks better than it should. If you credit component transactions or supplier kickbacks in ways that flatter margins without corresponding underlying economics, short-term targets click into place while long-term reality is merely delayed. The investigation report described a pattern: cost to complete estimates pushed downwards, losses parked, timing judgments stretched, and red flags muted in the name of do not cause trouble culture. Across consumer electronics, infrastructure, and semiconductors, the specific tactics varied, but the direction of travel was the same. Incentives formed the bloodstream. Bonuses and evaluations for managers hinged on hitting top-down figures. Miss a number, and careers stalled. Hit the number, and teams were rewarded, even if the path there ran through borderline interpretations. At the corporate center, A smooth earnings trajectory sustained access to capital, supported credit perceptions, and maintained prestige in a club where reputation compounds like interest. Investor relations benefited from a story of resilience despite headwinds in legacy electronics. Lenders saw predictability. Outside auditors faced classic client pressure dynamics, say no, and you jeopardize a marquee relationship, say yes, and you risk missing the cumulative drift. None of this requires criminal masterminds. It requires a steady directional nudge system where every nudge is temporary, every fix is timing, and the sum of all temporaries becomes structural. Controls failed for banal reasons that become catastrophic in combination. Internal audit did not consistently escalate. When it did, escalation entered a hierarchy conditioned to avoid surfacing problems late in the reporting cycle. Risk committees saw snapshots, not the stitched panorama across divisions. The external auditor, whose job is to challenge management estimates, missed the scale and persistence of the optimism embedded in long-term project accounting and margin credits. Documentation existed to justify choices, but documentation is not evidence that estimates were unbiased. The cultural substrate, avoid confrontation, respect senior directives, deliver the number, made it hard for gatekeepers to reframe targets as constraints and halt the march. That's how normal processes, under stress, become a conveyor belt. Enforcement landed where the evidence pointed, at the company and at its gatekeepers. Japan's Securities and Exchange Surveillance Commission recommended a record administrative penalty for accounting violations, and the Financial Services Agency imposed it, signaling that overstating earnings is not a victimless timing issue. Regulators also sanctioned the audit firm's local affiliate, with both financial penalties and a suspension tied to deficiencies in the audit of the company's accounts. The message was explicit. When audits fail on fundamentals, like challenging estimates in percentage of completion accounting or interrogating unusual profit credits, enforcement will treat that as a market integrity problem, not a mere technical foot fault. In parallel, overseas authorities opened inquiries, because global investors had relied on the financials when buying depository receipts and other instruments tied to the company. For victims, the damage arrived in slow motion and then all at once. Shareholders saw market value evaporate as restatements and penalties reset expectations. Employees faced job cuts and restructurings as the group sold assets to shore up the balance sheet. Suppliers and project partners encountered renegotiations or delayed orders because cash that once looked durable proved less solid. The reputational hit was brutal. A brand that had stood for reliability found itself shorthand for governance failure. The capital markets angle is equally stark. Japan had been promoting its corporate governance code and stewardship code to attract global capital. A scandal of this size tested whether oversight was improving where it mattered, earnings quality and board independence, not only on paper. There is another lens that clarifies why the system bent the way it did: board architecture and the corridor of permissible dissent. At the time, many large Japanese issuers were still transitioning from traditional insider-dominated boards to structures with stronger independent oversight and audit committee muscle. In that in-between state, the mechanics of skepticism often rely on personalities rather than hardwired process. If a director lacks the mandate or data to challenge percent of completion assumptions on an infrastructure contract, the debate becomes a ritual, not a stress test. Audit committees can only interrogate what they see. If divisional results arrive smoothed and footnoted with optimistic cost-to-complete narratives, the committee's questions risk becoming rhetorical. That same dynamic affects the external auditor. When management frames deviations as timing and presents plausible documentation, the burden shifts to the auditor to prove a negative across sprawling projects. Add prestige. Few want to be the person who says a national champion's numbers don't add up, and you get a bias toward acceptance until contradictions stack high enough to be undeniable. This is why governance reforms emphasize not just independence on paper, but information rights, direct reporting lines from internal audit to the audit committee chair, and a compensation mix that rewards quality of earnings. None of those are dramatic. All of them change the gradient that, in this case, pointed relentlessly toward target-compliant optimism. The signals, in hindsight, were legible, A company promising stable margins across cyclical segments without a clear operational explanation. Repeated reliance on accounting estimates in long-term projects where the cost to complete line consistently proved better than expected. A culture where bad news was linguistically softened until it disappeared, and where managers learned to negotiate the number before they negotiated the reality. For investors, the due diligence takeaway is crisp. Trace the bridge from operating KPIs to reported earnings, project by project. In businesses that use percentage of completion, model sensitivity to cost to complete assumptions, and insist on variance analysis across periods. Watch for offsetting credits that arrive just when margins need a lift. Compare segment-level cash conversion against reported profit. Read internal audit disclosures and external audit opinions for hints of recurring, unremediated findings. And in any jurisdiction, map the posture of the local regulator. When a watchdog moves with record penalties, it reflects not only past misconduct, but an intent to recalibrate future behavior. This is not an anti-accounting story. It's a governance story about how accounting, a language of business, gets twisted when speakers are rewarded for poetry instead of truth. Tools like percentage of completion exist to tell a fairer story of long projects than crude cash accounting would allow. But that fairness depends on humility and estimates, muscular challenge from auditors, and a board culture that treats we missed as survivable and we misled as unthinkable. Where those conditions are absent, even world-class engineers and products cannot carry the day. Earnings become a negotiation. Investors become the counterparty who never knew they were in a trade. If you follow markets to learn, not just to profit, log this case under how systems break quietly. The biggest red flags were not exotic. They were the familiar ones. Unwavering targets in volatile businesses, recurring timing explanations, and a hierarchy allergic to surprise. The fix is equally familiar and equally hard. Upgrade board independence beyond resumes. Pay auditors for skepticism rather than for service breadth. Give internal audit a direct oxygen line to the audit committee. And hardwire incentives to quality of earnings, not just quantum. None of those steps grab headlines, but they block the slow drip failures that turn into front page scandals. If this unpacking helped you see the mechanics behind the headlines, share it with someone who follows corporate drama for the plot, but wants the wiring diagram underneath. And if you want more deep dives that treat accounting scandal as a system, not a punchline, you know what to do.